Okay. I am actually live right now, and I appreciate everybody tuning in. This is Noel Christopher with the SFR Roundup, my LinkedIn live show that I try to do weekly, sometimes every other week, sometimes 2 or 3 times a week. Purpose of this show is to talk about the single family rental space, talk about things we see in the housing market, and bring great guests on. Today, I have a great guest named Adam Goer with Goer Crowd, and he is an expert in real estate branding, syndication, and he actually has contrary beliefs about the housing market than I do. So this is great. So we're going to have a great conversation. So I'll be bringing Adam on here in just a second. And I appreciate everybody tuning in. These shows always are interesting to do. So Adam, can you hear me? See me?
Here I am. Yes, I can hear you loud and clear. You're live and I'm dead. So we're just fine.
So this is the new thing, doing a live show with Adam. So we're going to try not to throw him too many curveballs. Right. If you have any questions, comments, concerns, whatever it is, please post in the comments. We will be monitoring the live feed for anybody posting any questions. And we really appreciate Adam coming on the show. He was a little reluctant, for one, because he doesn't have the same view on the housing economy as I do. So we're going to talk about that later. But first, let's talk about what you do, real estate branding, what you do in syndication, why you believe in it, and go ahead and give me your. This is your time. The floor is yours, Adam.
All right, no, good. Thank you so much for having me on. First of all, let's deal with some admin. So I've got for all those who've not done a live,
we'll be monitoring. Sorry about that.
Right. For all who have not done a live broadcast, and this is the first time I've done one, it's very cool. You asked me to check my notifications. So
yes.
That's what I've got on my phone. You want me to join?
No, you can, or just take that same post and then share it, because that will share the link, or you can share the actual, if you like, you can join the broadcast and share that link. There's going to be on the very bottom, there's a share button there. You can share it with your network. That way they see.
Oh, wait, it's something ghastly.
There's a little bit of a delay. There's probably about a 15-20 second delay.
Okay.
But yeah, if you share the broadcast with your network, that way everybody will see it, and your fans, which I know you have many.
Right, both of them actually. Yeah, my wife's listening, so that's one of them. Anyway, let me just see if I can actually share this thing. But no, it did. It opened it up again. All right, so I'm going to hold off from doing that. Just so that I don't screw up too much here. But I have seen some of your shows, so I know that it is a little bit ad hoc. Maybe this is it, actually. There it is. Okay, so I can turn the volume down. Share. Okay. Is it share to LinkedIn?
Yep.
.com. Did I just do it? I have no idea what I just did.
Should give you a chance to write a post or share in a post.
All right, so I can post it. All right, so let me just go ahead and post it. All right, post successful. So there we go.
Perfect.
That's all the technical stuff out there right now. Of course, I've forgotten exactly what you asked. Just kidding. I know exactly what you asked. So, all right. Well, hey, so thank you, first of all, for having me. It's a real pleasure to be here. We had a nice chat last week. You're quite right. I was concerned primarily because we have such contrary views on the housing market. I don't want to just be an enormous spanner right in your work.
That's okay.
So you know exactly where I'm coming from. You know exactly what you're getting, right?
Yep.
So, and of course now there's I've managed to get a fly in my studio. So
well, you know, I'll make one comment too on that, is that, and I do appreciate you doing this, is that as we started to get into a debate, you were like, stop, let's not have this debate now. Because we don't want to think about it too much and think about, and it's true. Let's have this debate later. And so we stopped right immediately, and we'll have our debate later on in the show. So it's all so friendly and great.
All right. So gosh, so what do I do? Well, in a super high level nutshell, right? To mix metaphors. My background is, gosh, 35 plus years in real estate, investment and finance. And the short story is that I sold out right before the last downturn and got involved in distressed asset divestments for banks and private equity funds, for a major bank and for one of the largest private equity funds in the world. And then when the economy pulled up, all that great distress stuff went away. And so actually, Noel, I reinvented myself. It's as simple as that. And sought out different ways of enjoying the real estate industry, right? An industry that I've come to know very, very well. And I actually landed in an incubator, a startup incubator, and started to invest in these small companies that were powered by students, right? 18, 19, 20-year-old kids who were speaking a language I really didn't understand, right? The language of digital marketing. Words like funnel, right? Or whatever, yeah, crazy stuff. I had no idea what they were talking about, but I knew that it was something very profound. And at the same time, there's actually some interesting things going on in your space, and we can get into this a bit later as well. Some big news yesterday, actually, in your industry. But at the same time, the laws changed in the real estate capital formation or in real estate finance. And from having been prohibited to raise money for real estate deals online, suddenly it became legal, right? After 8 years. I mean, basically, never been allowed. And so I immersed in that.
So why don't you, because some people may not be aware of that. So first, after you go through this, I want to kind of go back to the beginning, because I'd like to hear a little bit more about the beginning of the story. And we kind of talked about this before, but tell a little bit more about that. What you're just talking about, how it was illegal, now it's illegal as far as raising money for real estate funds.
Okay, so I actually wrote a book about it.
And, you have the book?
Almost within reach. Yeah, hold on
one
second. I'm going to go off screen here now. Shameless plug.
It's okay.
Here's my book, Leaders of the Crowd. All right, you can get it. It's a real book. It's actually published by a publisher. It's not an ebook. It's the real deal. Leaders of the Crowd. And in that, I actually interviewed people from the White House, from Congress, lobbyists, and some of the early movers in the industry. So it's a pretty detailed account of how the industry's changed. In the super fast version is that in 1933, there was an excess of liquidity, and it led to the Great Depression. And so Congress elected or passed laws that prohibited companies from raising money from any other than through an IPO. Basically, you had to go through an IPO. And so what this did was that it disconnected real estate developers from the public market. They were allowed to raise money without disclosures that were necessary in an IPO, without the restrictions of an IPO, but it had to be only from people who they knew, right?
Accredited, right?
Accredited investors came later.
Okay.
Came some years later.
Yeah.
But basically, the crux was that they were prohibited from advertising unless they did an IPO. And it was all intended for companies. It was never intended for the real estate industry. The real estate industry has always been an unintended consequence of these securities laws. Well, in 2012, when there was a lack of liquidity, small companies were really suffering, right? They couldn't raise money. The only way to get to public markets was to do an IPO. And of course, that prohibited or restricted only Facebook, right? Does an IPO, but a small startup doesn't.
Right.
So Congress passed a new set of laws, and that new set of laws basically said you can advertise. And what that did, an unintended consequence of that, was that it allowed real estate sponsors, real estate developers to, for the first time, actually advertise. They could go online, they could put up a sign, a website that said, hey, come and invest in our deals, right? So of course, there's some restrictions. It's not quite as simple as that, but it opened up this new world. So now you have this entire world. I don't know if I just switched the share off, right? But here's my right that have no clue. They're all like this generation of seasoned real estate developers, right? Like me, who have no clue or had no clue how to use a phone or how to use live broadcasts or how to use social media because it was prohibited. But now we can do that. And so that's the intersection between digital marketing and real estate capital formation, real estate finance is this intersection that I work in now. I provide or I build systems for sponsors so that they can raise essentially unlimited capital online using social media.
That's great. So you really get deep into branding and how you present those, because a lot of people don't know. And I'm a little bit familiar with syndications, but I'm probably going to be talking to you, just a side note, a little bit more detailed about some things that I'm personally doing. So I think it's a great way to raise capital. Now, what we're going to get into a little bit later is the asset classes, because we have some differences of opinions on the asset classes. But so I'd like to go back a little bit more on your story. So one, how, you kind of started in the middle of your story. So you started at, you were on the real estate side, but what were you doing before? How did you get to where you were? And so where are you from? Where'd you grow up? You're obviously not from America originally.
And well, whenever anybody asks me where I'm from, I always like to say I'm from Lubbock, Texas. And then I ask them, have you ever been there? And no one says yes. Everyone says no. So it's, well, this is exactly how we speak in Lubbock, Texas.
So I didn't know if you knew this, but I played rugby and I've played rugby all over the world. And I've had experience with a lot of what we call funny talkers. And so I would put you in that category. But so tell me how you came to do what you're doing now. I mean, not just what you're doing now, but how you got to the start of your story. How did you even get there?
Well, it's a very, very nice of you to ask me, Noel. I mean, we're going back to, pre-telephonic communication as far back as I go.
Pre-internet, for sure.
Before faxes, before cell phones. I mean, this was, computers were steam powered, right? It was a very long time ago. I actually started pulling wires for an electrician. That's how I started. I used to work for I'd do anything for $5 an hour, basically. And I did do anything for $5 an hour, but I ended up working for an electrician. And one thing led to another. I ended up, it's a long story. I won't go into too much detail, but I got hooked up with a small investment bank, Japanese investment bank in the 1980s, early 1980s.
And where was this?
In San Diego.
Okay.
And they were doing M&A work. And somebody I knew, a family office actually that I knew at the time, was doing ground up multifamily development. And I would sit and have breakfast with the principal, and he was telling me, yeah, this is how it works, and this is how the money's made, and we do this and that, and they showed me some spreadsheets. And so I took that back to this Japanese shop. And of course, there was a huge influx of capital from Japan in the 80s. Mm-hmm. And so they jumped on that bandwagon, and I ended up raising, in excess of 30 million in 1980s money. So that's, when 30 million meant something in 1980s. Remember, by the way, in the 1980s, it's interesting to reflect upon this. When I first got into real estate, interest rate, you could get a mortgage in the low 20%.
Right.
A deposit, when you deposited money in the bank, the bank paid 12%, right, on the deposit.
For those of you who are worried about interest rates right now, right?
All right, so I mean, it was a different, and by the way, that was at exactly the time, interestingly, that the accredited investor standard was laid down, right? And it hasn't changed since then. So as a consequence, there are now, at the time, there were around 500,000 accredited investors. Because the standard hasn't changed, there are now in excess of between 11 and 12 million accredited investors. It's changed a little bit,
right,
but not much. Income standards haven't changed, for example. Anyway, so that's a very long time ago. And then when there was the savings, and this dovetails into what I'm sure we'll chat about. Then there was the savings and loan crisis of the early 1990s, very late 1980s, the early 90s. And that pulled the rug out completely of the real estate industry. And so I ended up going to Japan, and I was asked to go there by the folk that I'd actually raised all this money from,
right,
who lost their money, to help them with their divestments. And I ended up being hired after that by Universal Studios, actually a joint venture of Universal Studios and Paramount. And I was hired as Daihyo Torishimari Shacho, right? What the heck's that? That means I was the CEO of a division. By then, I'd learned to speak pretty fluent Japanese. And then after that little exciting run, I came back to the States, did a little .com investing in the early 2000s, and then got back into development work, Noel, and just working on my own account, raised money on my own account, did my own developments. And in 2007, something was going on in the market. I couldn't at the time put my finger on it, but I was very worried. And so I sold my entire portfolio. So I went into the downturn with dry powder and no legacy problems.
That's great.
That's my story, and I'm sticking to it.
So tell me a little bit more about, because as you know, and people listening know, I've been involved in the single family rental space, and you were kind of there right in the beginning when, for people to understand, is that the bottom of the market really was around 2012. That was really truly when the bottom of the market was. And some of it can be attributed to a lot of different things, but a lot of people attribute it to a lot of a few of the institutional funds coming into some key markets in the U.S. and start buying. They started buying homes at the very bottom of that market, and that kind of, I know in Chicago, it really kind of set the bottom of the market. People started seeing there's investments. I mean, we were buying hundreds of homes a month. You were there in a different position than I was. So I was there as I was called by Blackstone, by Invitation Homes, and said, "Hey, we heard you know what you're doing in Chicago in real estate investing. We want you to start buying for us." And I didn't even know who Blackstone was. I mean, I'd heard the name, but I didn't know much about it. And you were in a different position. So tell me a little bit about that story.
Yeah. So, truth is as you tell it, right? So my perspective is my truth. It may not be exactly how it happened, but I'll share with you how I saw.
I'd like to hear
the origin of the industry, this single family home for rent as an institutional asset class. So I was brought in after I'd worked at the bank. I was brought in again. There was a couple of steps in between, but eventually I went over to work for Tom Barrack at Colony Capital, who at the time had purchased around $7 billion worth of distressed or non-performing real estate collateralized loans,
which were basically giving away at the time, right?
Well, I don't know. There was a lot of competition for them.
Right.
The FDIC were providing some zero interest loans. It was a very, very interesting stuff that was going on at the time. And so Colony competed pretty aggressively against others, lost some, But we ended up buying these huge portfolios of non-performing loans that ranged from empty lots, right, all the way up to, you know, much large, very significant commercial buildings. So these huge loans, 7 billion. It was an enormous portfolio. And so my job was to come in and assist with divestments and actually with workouts. So that's what I started to do. And I had an almost impossible task, Noel. The first portfolio that I was given of loans to work on from this thing were non-performing notes, right? Non-performing loans. So mortgages that said IOU to the bank that had been in default for months and months, in some cases years, right? On vacant single-family lots and abandoned single-family homes in Detroit, right? So I had this ridiculous portfolio. And when I looked at the market in Detroit, the first thing that I saw in the headlines was foreclosures in Detroit selling for $1. So I thought, wait a minute, I've got IOUs on the debt on those properties. How the heck am I going to get a single penny for any of this stuff? I mean, it's zero value. But we actually did very well. We found buyers who apparently knew what they were doing. I never stayed in touch with them, but they had confidence that they could make money out of these portfolios. So one thing led to another, and I started pooling or putting together small pools of reperforming multifamily loans and selling them to banks, right? So it's slightly different kind of thing. But at the same time, this was just as the market was ever so slightly beginning to pull out of its malaise. And again, this is just how I saw stuff in the kind of the ether around me at Colony. But there was this idea that we had these huge portfolios of loans. A lot of them were on single family homes. And there were some circumstances where, you know, the guys that were managing the portfolios would call a borrower, right? And they'd say, this was as bad as it was, and would say to them, hey, you've not paid on this loan for 3 years. You know, what's going on? And so the poor person at the other end would say, well, yes, you know, we got a notice the bank had failed. We sent a check. Right. It came back to us and nobody wrote to us. Like, nobody called us and told us where to say, how do we bring these current? So suddenly there was this whole range of circumstances that was just out of the utter chaos that was the last downturn. And so what I saw was inside Colony, this little division starting, where the idea was that they would start buying or taking ownership of these homes, some of these single family homes, and renting them. And it happened very, very quickly. Right? Suddenly went from a guy on a desk with an idea to it. I remember as I was segueing out of Colony, that it was being talked of as a new asset class. So it just barely started. It was a total startup, actually.
And, you know, I find that funny because at the time when they were talking about this new asset class, there were approximately 12 million single family rentals in the country.
Yeah, but they weren't huge pools though.
No, they were not. And they're still not. And so, you know, so for people to kind of understand, you know, it's now there's about 17 million single family rentals, about 23 million if you add in 1 to 4 units or 2 to 4 units. And it's still 50% of them are people who own one house, 80% of people own 1 or 2 houses. So it's still very, very fractured. So there's a huge long runway in that space. But anyways, okay, so continue.
No, does that include the Airbnb type as well, market?
No, this is long-term rentals.
Long-term rentals.
Yep.
Yeah.
The Airbnb market, the second home market, is actually pretty small when it really comes down to it. But yeah, I mean, pretty small. But an example where I live, there are 5,000 out of, 5,000 rental units. I live in a resort town. So, it's kind of concentrated in different areas. But yeah, no, that's not including the Airbnb. When I'm talking single family, I'm talking just long-term single family rentals.
Family homes. Yeah, it was, it was a very interesting evolution of the market.
Absolutely.
But again, the reason that I contacted you and said, Noel, I'm not sure I'm the right person for your show is because, I was never really involved in that.
Right.
And I've always been, as I told you when before we've chatted today,
so
always been skeptical. But
go ahead. So let's jump into what you do though a little bit more about syndication and what is have you done, and this is just a general question, I think you answered this before, not today, but have you done any syndications where people are buying single family rentals? What is your design? What do you think the best asset class to syndicate is? And how does that process work? Because I'm genuinely interested in how that works.
Okay, sure. So first of all, I haven't done any single family home rentals. My clients are either multifamily, ground up condo, downtown office skyrise owners, etc. No single family.
Well, maybe I'll be your first customer for a single family syndication.
Sure, I'd be delighted to work with you, Noel. But now your question was syndicates. Okay.
Yep.
So in my other book, right, this one's very much different from the first one. I actually looked at some of the very earliest syndicates in America. It was syndications that America's basically founded on financial syndicates. And the old banks, JP Morgan, and the book I wrote was about a bank called Kuhn Loeb of the late 19th century, early 20th century. And they formed these incredible syndications to finance the infrastructure, the railroads of America, which is really what, was the backbone of American growth, essentially. And a syndicate really is just a group of people who come together, pool their money with a single investment objective in mind. And typically, there is somebody who manages the execution of the business plan, right? That's the manager, right? And then they will syndicate because they don't have enough money to do it themselves, they will syndicate the money that's required to a group of historically high net worth people. So what the change in the law did in 2012, actually the laws were promulgated in 2014. So it's really it's absolutely brand new industry. And importantly, it's an industry that's only been around during a bull market. Right. So all success.
That's interesting.
Any new industry in the last 10 years has only been,
I try to remind people of that many times in different situations that the last 10 years are,
Yeah, they almost don't count.
Right.
When it comes to survival anyway. So what the law did was, so historically what had happened was that because in real estate, developers were restricted to only raising money from people that they already knew, it tended over time to become an increasingly wealthy group of individuals who invested increasingly large amounts each. So there's a guy here in town, for example, if you want to join one of his syndicates, the buy-in's $1 million, right? If you got $1 million, you can buy in, right? That's basically it. It became known as the country club, right? Country club money. So when the law changed, the law said basically anybody can invest, and there are some variations, right? There are some opportunities for non-accredited investors, which is basically everybody over the age of 18 can invest. But for the most part, the syndicates are still with an accredited investors. And just to define that to that one person in your audience that doesn't know what it is, it's 200,000 of income for the last 2 years and a reasonable chance of the same this year, or $1 million of net worth, not including your primary residence, right? It's an accredited investor. And so by being able to go beyond the small group of people that sponsors historically came to finance their projects with, it might be 20, 30 people, right? Maybe 50 people, all super high net worth. I need 10 million for this deal. And they all come in with $500,000. You get it done fairly quickly. So what happened was now you can go online. And so minimums went down. And there are sponsors who raise, I mean, there are some really unbelievable opportunities that if you're non-accredited, I think you can invest as little as $5 on some sites. Really crazy. But for the most part, the minimum is, you know, $10,000 to $20,000 is your minimum buy-in. So it gave developers the opportunity to reach high net worth individuals that they had been prohibited from reaching ever before. And it gave those same high net worth individuals access to investments that had previously been the domain of these kind of closed door exclusive groups across the country.
That's interesting. So how does it work when we're working with you? So do you set it up? Do you help somebody set it up from start to finish? Do they need to have a plan in place first? I mean,
yes.
Kind of walk me through that a little bit.
Sure. So I do limit my self to invest working with developers who I have deep belief in, right? Yeah. And I really think that they're credible. They've got a good track record. They have to have had a track record that goes beyond the last recession, ideally, and ideally even further through prior recessions. They have to have a good pipeline. They have to have a good story, good history, and be highly credible, right? So I don't help just anybody, right, to raise money. That's first. Because
I mean, correct me if I'm wrong, but you're putting your name behind this in a sense, right? Because you're advertising it on your platform. And
well, not really. I almost never am up front and center with any of the work that I do for my clients. I have one client actually in Tampa, and I could certainly mention his name. He's been more than happy for me to. It's a group called Feldman Equities. They are 100-year plus family office. They built the Chicago airport, for crying out loud, the terminals in Chicago. And but typically I don't, and I don't recommend investments either. I don't have a license that qualifies me to do that. So I don't recommend, I'm not allowed to recommend, and I don't. Everything that you're hearing today is strictly for entertainment purposes only.
Got it.
But what I do is I build systems for developers so that they can get their message out. Now, no, these are not new systems. Right. These are systems that have been developed and honed and perfected by just about every other industry, right, in existence. It's just been prohibited for real estate developers to use them, to use digital marketing, to use social media,
right,
to send out automated emails, to trigger funnels, to to create content online in order to raise money. So what I do is I apply best of class systems from other industries. I've been tracking the early adopters from this industry, right? So I've been since it started, I've been watching these the best of class practitioners in real estate. And I've created a system that I actively build for real estate developers so they can raise money online. And that basically what that involves. And by the way, if I can just plug briefly, if you're interested, I have to tell you this morning, of course, my blooming website had a meltdown of all times, right? It's
I know.
I think we fixed it. I hope it's fixed. But if you do go to my website, gowercrowd.com, and to the podcast page, there's a link there that talks about the whiteboard workshop. So click on that, and I actually walk through. It's a 39-minute video. You can watch it at twice speed, so I sound like a chipmunk, but you can watch it in 15 minutes or so. I walk through the whole thing. But at the core of what I do is to build content, right? You got to educate. As a developer, you have to educate prospects about who you are, what you do, and what your value proposition is. And most developers are used to doing that, but they're used to doing that over lunch, right? You meet somebody for an hour or 2 hours, you'll set up a meeting, and you'll explain your background and what your deals are, etc. So what I do is take that exact narrative and digitize it. Is that my site up online?
This is your site right here.
All right, there's me, and that's my high school graduation.
Yeah, I was going to say, looking good. You're looking good. Right. You've aged quite a bit since I last. That's okay. It's all good.
Good. I'm glad that you can see the real me. I'm glad that I'm alive. It should say you are alive, actually, right, instead of you are alive on my screen here.
And by the way, Adam has a great podcast. Prior to this, the last month I've listened to parts and whole of many of your podcasts, and really enjoy it. Really appreciate it. So I highly recommended going, and maybe someday you'll have me on if you can be agreeable to my real estate investing morals.
We should talk about it. Let's table that, because actually doing a live broadcast is very, very cool. So let's talk about that. So you're on. We'll table that for later. For sure. But we were talking about something else. What were we talking about? It's all about content, Noel. And basically taking the pitch as a developer, taking your pitch and explaining your background, and instead of having a 2-hour lunch where you go in and, like, you've asked me all these questions, my background,
right?
Can you imagine? That's what developers do all the time. They go and meet somebody, and they have to go through that same thing again and again and again. But now you don't have to. You never, ever have to do that. If you record it and produce it in small sound bites in exactly the way that people consume information today, and distribute it on social media so that you are, and your story is everywhere all the time, right? So that everybody can listen to it whenever they want. That's how you raise money today.
Well, and so what's amazing is that, and I know this is how we connected was through LinkedIn, and LinkedIn is the most powerful tool for doing this, for business to business, for connecting on a personal level. I mean, look, your customers and the customers, or the partners, I don't know what you call the investors, or the investors of their syndications, are people like you and me that are professionals on LinkedIn. Anybody that has a professional career is on LinkedIn these days. Then it's no longer a resume. So it's no longer a place for jobs. It is a place to engage. It is a true social network. And we do the same thing on our listings. So on our listings, instead of the static page, it's a video. It's me going, hey, this is the listing. This is why it's great. In fact, I have an interview with the owner. You can hear directly from them why they bought this portfolio, why they thought it was valuable, and why they're selling. And so that is so powerful that you're right, recreating that meeting over and over, and pitching and all of those things. You can just put it all out there. And it's why I'm living in Steamboat Springs, Colorado right now, because I don't have to do those lunch meetings all the time. When I was in Chicago, that was my life. It was lunch meetings. It was the health club meeting at lunch there. It was just constant. And now I do this. And so I can get my message out to the world without, there's no filter in between. And now we're doing this like a live broadcast like this. There is no filter. This is it. this is a conversation. So obviously I'm passionate about it.
I've noticed there's a slight delay. So there's definitely somebody at LinkedIn there ready to go stop.
Right. Yeah. Well, I think we could go pretty far before any kind of a delay. So talk a little bit about, I mean, you're kind of getting into it. Talk a little bit about the branding. I mean, is it primarily on LinkedIn? Are you putting it on other social media? I know you're about engagement, and it's important for, you could put your story out there as much as you want, but if you don't go and engage with people consistently, you're not going to be, you're going to not be as successful. Do you agree? Or
okay, so that's actually an interesting point. By the way, there was one thing that I did want to mention before I forgot. And one of the advantages of digitizing, a fancy way of saying recording your pitch, basically, in a way that is social media friendly and getting it up online, means that it ends up working for you, becomes an asset to your company. All this content that's out there, right? So I just said here, check out the workshops. I don't know if anybody actually clicked on that, but I get notifications all the time. I'll get up in the morning and have a look at my inbox, and I'll see a few people have registered for that workshop literally while I was asleep. I know it sounds cliche, but this is out there. And what happens is that what's the next thing somebody does? They go online and they run a Google search, Adam Gower crowdfunding, right? And they see the LinkedIn profile and Twitter and Facebook and the website and articles and podcasts and et cetera, et cetera. These are all assets to the sponsor, to the developer, that are working for them once they get it up and once they get it out there online.
And it's just about, I mean, I haven't seen as much about it, but is it just about them building a personal brand as well too?
No, it's so that's, gosh, these are all really good questions. I can tell you must have been listening to my podcast, because these are all questions that have come up. It really depends on the personality of the company, right? So some people, they love talking on video, right? They're just super comfortable doing a video. Other people simply cannot imagine, right, recording themselves on video. And so we go with whatever and then there's some people that they are the personality, right? The personality of the company. So they drive the message. The personality of the individual is what drives the message.
Yes.
Whereas other people will put the corporate image up front and center. I did a great call with John Carden at Fundrise, right? So he is their CMO, super bright guy. And we had this discussion, right? If you go to Fundrise's site, there's no sign of any of the personalities, right? Ben Miller's not there. There's none of them are there. You go to other sites and it's all about the individuals. So it really depends on you, right? There is no cookie cutter.
No, there isn't.
The processes are predictable, right? That you have to develop content of some sort. You have to have presence on social media. You got to have a LinkedIn page, a corporate page, a Facebook, Twitter, a YouTube, ideally. Right, you have these pages. You've asked about branding. Each one of these pages has to look consistent, has to have consistent message. Whatever your message is on your website needs to be consistent on social media. Whatever your website looks like in terms of its image, right? It's the photograph at the top of the page, called the hero image, right? Top of the page. That should be replicated on social media, so that whenever somebody goes to your social media, they know that they're with you. Right? Consistency goes to all the copy that you put out, all the articles you put out, the thought leadership. And by the way, we produce all of this, right, for our clients, right? Suits and nuts. So it goes out on your articles, on your videos, on your audio. They all have thumbnails. They all have cover art for the articles. That all has to be consistent with your brand and with your message. Yeah, go ahead.
So the quick question, and you don't have to go too much detail on this. Are you, how do you get paid? Are you a fee for just a flat fee? Is it a part of the deal? How does that work?
Yeah, no. So I am basically a digital. It's hard to say this because I never imagined I would be, but I'm a digital marketer. My company is a digital marketing agency. So we provide this service for a fee, and there are various types of different options. So we'll do SEO for you. We'll create the content for you. There's a basic service. There's all kinds of things. List acquisition and management. We'll do that as well. So these are all bolt-on services. It is not legal, actually, unless you are a licensed broker-dealer, to take a percentage of a raise, of a capital raise.
Okay.
Plus, at the end of the day, Noel, seriously, I could build the ultimate social media digital marketing machine for you that outstrips everybody else in the industry, right? Because you put everything behind it, video, articles, massive coverage on all social media, and you might not raise a single penny. Why? Because it all depends at the end of the day on your deals, right? And your integrity and your story and your background and your ability to deliver and to show people that you're capable of delivering. So at the end of the day, it's up to you.
So yeah, I mean, what you do is important, obviously, and it's that system and the process and then getting it out there. But how much vetting, and this is going to be my last question because we're going to move on to the other stuff. How much vetting do you do of the actual promote that they're promoting for the syndication?
The deals?
Yeah, the deal.
I don't do any vetting of the deals. I don't do any underwriting. I'm a marketer.
But you vet the principles, so you're confident that they know what they're doing before you get into it. So you don't feel like you need to vet the whole deal because you vetted the people, right?
Yes, I need to know that they are I need to know that first of all that they have a track record, ideally a multi-cycle track record. I need to know that they are professionals in their field, that they already have investors, right? Typically, that they are in an industry or in a niche that they have a special angle on, right? That they are going to be successful. So and they also have a commitment to the long term, because it's not quick. Taking me, I'll build out the basic system, we'll get it up and running within 90 days. But that does not mean that you're going to run around with a hat in the office as the money falls in through the ceiling, right? After 90 days.
So what is a typical time frame?
To really build up, to gain momentum, takes between 9 and 12 months before you really start to see significant traction. But keep this in mind. So I'm going to hark back to one of your first questions. And the first question pertained to my background. My background during the last downturn was in divestments of non-performing loans, distressed real estate. And there was a very interesting dynamic at that time. One of the reasons that prices dropped as precipitously as they did was because liquidity was sucked out of the market. Right. Money stopped flowing. So being inside a bank and actually in private equity fund, the only people that I was dealing with were developers or sponsors, investors, who had cash. Now, when I was at the bank, I was actually able to write them loans. I was able to write loans to buy loans. It was a kind of unusual circumstance. But that aside, this small pool of people that I knew, just a few thousand people who had some cash, they had access to me. But there was this huge population of people who had money, high net worth individuals in the market, professional, like medical professionals, physicians, and accountants and lawyers who had cash, who were still making money even during the downturn, who wanted in. Right? They wanted a piece of this incredible opportunity to buy distressed real estate, but they didn't have the access. And even if they had the access, they didn't have enough money to buy kinds of assets that I was selling. And at the same time, let me finish this thought. Sorry to go off on this.
Okay.
At the same time, the guys that I was dealing with, they had access, but they didn't have cash. And these two communities were prohibited from communicating.
Wow.
The sponsor couldn't advertise, couldn't say, hey, I know Gower at such and such a bank, and he's got the biggest pipeline of opportunity I've ever seen in my life. Invest with me and I'll buy everything from him. But today, you can do that. They can. Sponsors can advertise. And it is no good waiting until the next downturn.
Well, so that's a great segue, because let's talk about that, because the way I see some things, and you know, we have different views on this, or maybe they're the same, we don't realize it, but you know, people that are worried about a real estate crash and a real estate downturn and recession, and by the way, a recession and real estate crash aren't always in line with each other. You could have a real estate crash and no recession. You could have a recession with no real estate crash. You could have both. The last one, we had both. And I think people are under the false narrative that the last recession was caused by real estate. It wasn't caused by real estate. It was caused by like blindness to risk in all of the markets. And real estate was one of them, but in stocks and bonds and everything. And you kind of touched on that a little bit. But the way I see, for one, if there was a crash, there is so much money on the sidelines, and there's that you know, I personally know of many investors with billions of dollars that, you know, as markets shift a little bit, they're jumping right in. We're talking about how now those investors can talk to each other, the people without the money and the people with the money. So I don't see it happening like it happened before, if it did happen. And I see as well, you know, in the real estate markets, there's such a lack of supply that it's keeping things going. Now, there's a tech bubble that's happening, that's bursting right now, and we've seen it. I mean, WeWork was the number one, was something that happened. WeWork, and what was it? If you get up in the morning and you take a lift to work, and you take an Uber home, and you go to a WeWork office, and you ride a Peloton, and one other company, you're interacting with companies that have lost just this year $17 billion. So, but that being said, the real estate market, I don't see, I mean, looking at where values have gone the last 50 years, and just even, let's say, since 1996, it's averaged 3.62% single family home values. We're not at a point where things have gone so high that there is a place for them to go down, because there is so much demand. That's the way I kind of see it. I'm interested to hear your view on it. And I can pull up that graphic when you want me to.
Oh, right. This one that I sent you. Okay. So this is a full-on segue into something completely different.
Yes, it is, because we're kind of getting late on time, you know, so, but it was a good segue, because you're talking about how the last recession, there's a lot of things that happened where the banks weren't prepared. They didn't know what to do with distressed assets the other real estate owned. You didn't have a way for investors, people with money, to go find the people without money and work things out. I mean, look, I know banks, I had situations where banks were calling up loans, and there were developers who had the money to pay the loans, but the banks got their line of credit pulled, and they called these loans. And so you had people with money that were performing going out of business because of not of their own fault. So it seems like that part of it is absolutely different, because there's so much more liquidity, and even in what we're doing, where now you can sell a tenanted asset, and you can, there's a lot of different things happening. But I don't want to use the term "it's different now," but there are some things, there are some dynamics.
Exactly what I just typed on my screen to remind myself to mention, because I was sure that's exactly what you were saying.
There are some dynamics that are different. I mean, you don't have oversupply of houses, which you had before. You don't have the speculation. So, the people are flipping homes on very low margins now because you don't have that big speculative margin. And so those things are different. Now, if you're speculating and if you're buying a house and you're expecting it to go up 50% in the next 5 years, you're barking up the wrong tree. I just don't see, and I will pull up one thing because I'd like to get your opinion on this. Or actually, go ahead and give me your opinion. I'll pull this up in a second. But
all right, sure. So I just needed to shift gears.
Sure. Completely. Yes, we're shifting gears.
Now we're in subject 2. So look, the reason, as you know, the reason that I contacted you before when you were kind enough to invite me was because this single family home investing and fixing and flipping has never been something that I've been very comfortable with. It's never really made sense to me. It's always seemed to me to be a game of musical chairs. You know this game. Mm-hmm. When the music stops, if you're still holding whatever, the parcel or the chair's gone, you're the one that's out, right? Basically. And I remember my very first exposure to single family homes was in San Diego in the mid 80s. So gosh, a long time ago. I remember seeing somebody buy a house, literally paint the exterior, put it back on the market just a few months later and make, I don't know, $100,000 on something. And to me, it was, it made no sense. There was something fundamentally misaligned with economics, if that was possible. There was no true value added. They were simply capitalizing on a macroeconomic growth, right? Macroeconomic trend to make money. You buy a house, do nothing, and sell it for more, basically. So it was always, it always made me uncomfortable, this idea, because there is always a downturn and there is always a reduction in valuations. It always happens with a capital A. It's the only guarantee in real estate. What goes up will come down. And part of the first podcast series, and this is this graphic I think you have that I sent you to chat about.
Yep, I'm about to pull it up
my
right
first
now.
Podcast series, when I was first discovering the digital world and experimenting actually with podcasts originally. I spoke to a lot of professors around the country who had something interesting to say about the real estate industry. You know, these guys and women, men and women, are among the brightest in the country. And yet their papers are so steeped in academia that I would ask them, how many people have read this paper? It's this fascinating paper. And very proudly, they would tell me, oh, at least a dozen. It's like, what are you kidding? This is important stuff. So I had a conversation with, as you know, with a fellow professor, Charlie Nathanson, at the time anyway. I'm not sure where he is today, the Kellogg School of Business at Northwestern. And he had done a study that looked at the psychology, what actually drives the upward momentum of prices in single family homes. Now, the way I like to see the conclusion is that we all see the warning when we buy stocks, right? If you listen to the earnings call or you read something about stocks, it always says past performance is no guarantee of future results.
Correct.
Right? As I said, we hear it so much that we're immune to it. We live of use of this platform. I probably clicked on that right when I set up the podcast. Of course I read it.
Right.
Right? Nobody does. Nobody just clicks, I agree. So we become immune to warnings and to this information. All right, so what Nathanson said or discovered